Tonight on Market Call, John DeGoey, Vice President at Burge Invest Big Securities. He'll be taking your calls and emails on personal finance and exchange-traded funds. Good evening, I'm Mark Bunting, and welcome to Market Call tonight. Thanks a lot for joining us this Friday evening. If you'd like to talk to John, if you have some questions about the personal finance or ETFs, those are his two specialties, you can call at 1-855-326-6266 or send an email to marketcall@bnn.ca. Good to see you.
Good to see you as well, Mark.
Now, I know you don't do market outlooks. You don't believe in prognostication generally. But let's just talk about what we saw today, a little snapshot of what we saw today. U.S. jobs, surprisingly weak. Markets not strong. And I think as the Dow Industrials are down 5 straight weeks now, worst run since 2004. Right. What's your general sense of what's happening?
What I would say is you try not to get too fussed about the macro data. So there tends to be a lag at any rate between what's going on in macroeconomic indicators and capital market performance. So as an example, we saw the stock market hit its bottom in March of 2009. And then it started coming back up, but we weren't actually, the market led out of the recession. The recession continued for another 6 months or so, and it wasn't until about Labor Day of that year that we actually started getting confirmation that we had in fact emerged from the recession. So getting the bad news on the macro data right now needn't necessarily translate and doesn't necessarily translate into what's going to be happening in capital markets.
It's often said the bond markets get it right, and the bond markets have been, the yields have been coming down, bonds have been rising, especially in the United States. Are they getting it right, or have they been getting it right lately?
Yeah, I don't think I want to comment on that because it's the sort of thing where I think there may have been some concern that there might be some tightening, and that's obviously not happening anytime soon. So maybe that's all it's really reflecting there.
Okay, and I'm just wondering what needs to happen, John, in the markets or economically to make you want to rebalance your holdings for your clients?
Sure. Really, what happens is that's nothing that's happened in the past, let's say, so far this calendar year, that has caused me to really want to rebalance. Because what happens is rebalancing occurs or is required when one asset class or more moves in a significant direction. And the past year, so far in calendar 2011, stocks have been more or less flat. Bonds have been more or less flat. And if the portfolio was in balance on January 1st, it's probably still in balance. What would cause me to change that view, though, what would cause me to want to rebalance is if one of the asset classes, let's say emerging markets takes a tumble, and you have 15% of your portfolio in emerging markets and it's dropped by a third, and now it's worth about 10%. Well, this would then be an opportunity to maybe take some money off the table from other asset classes to buy while emerging market equities are on sale, as an example.
All right, fair enough. Now let's shift gears here, John. You brought us a board, and you want to sort of stress the need for diversification in investors' holdings. So what do you want to tell us here? Well,
about a month or so ago, a mutual fund company called Brandis came out with a report where they showed that the 4 largest brokerage firms in Canada had about 90% of their assets held in Canada. That's striking to me because Canada only represents about 5% of the world's stock market capitalization. So when I talk about what we do in developing a balanced portfolio, I talk about 4 more or less equal-sized buckets: Canada, the U.S., developed, and emerging. Now you can see here from the board that's significantly overweighting Canada, because Canada is only 5% of the world's stock market capitalization, but it's a lot less overweight than you see almost everywhere else, because home country bias exists everywhere. But if you can find a way to get money to other parts of the world, and I might also add that, say, a decade or two ago, Canada would have been 2 or 3%. The U.S. was at around 70% 25 or 30 years ago.
Really?
So it's not that the U.S. hasn't grown. The U.S. has grown. It just hasn't grown as quickly as the rest of the world has grown. And in particular, the emerging markets, which are now very close to 20%, they would have been a rounding error. Would have been very close to 0 25 years ago. So when you think about where the growth has come from and where it's been, it's coming largely from emerging markets.
I saw a story the other day which suggested, it was a survey that suggested that high net worth individuals in Canada prefer to keep most of their money here in Canada. Do you find that with your clients, and do you try to change their mind?
I think most people, as I say, home country bias is the sort of thing that you see everywhere. So Americans prefer to keep their money in the U.S., Israelis prefer to keep their money in Israel, and so forth. To the extent that it's prevalent everywhere, I think my clients feel it less because I try very hard to get them to think globally. Think about the Canada being 5% of the world's stock market capitalization, think of going into a big box store, a Walmart or a Home Depot or whatever, and say there's a sale on, and there's everything on the store is in sale, but someone tells you there are 20 aisles in the store, you can only shop in one aisle. It's the same sort of thing here. Canada is 5% of the world's stock market capitalization. It's not that there aren't good buys in Canada, it's that there are equally good buys elsewhere around the world, but people are generally not looking at that. And in terms of getting a better risk-adjusted return and diversifying within and throughout asset classes, you can do better by getting things outside of Canada too.
All right, John, and I'm sure you'll be espousing that theme throughout the show as we talk about personal finance and exchange-traded funds. We'll come back with your calls and emails right after this.